Hello and what is going on, lovely people of the internet? It is hootmoney here with another video for you guys today. Today we are going to be talking about the SPAC market and how it's been absolutely crushed over the past few months. So it basically saw a peak in February, and ever since, if you guys have been holding on to SPACs, you guys have probably not been too happy with its performance. They've all pretty much gone down to the price floor, which is around $10 a share, which is basically their net asset value. So that's how much the SPAC, the special purpose acquisition company, holds in cash, while some of them have not, which shows the stronger SPACs. However, the whole SPAC market has seen a bit of a hit, and none of them are trading at their all-time highs anymore. So there's a reason for that, and that also shows that there may be a few good deals out there right now. So I'm going to be showing you guys my holdings in the SPACs at the end of the video, so make sure you stick around for that. If you guys are new here, make sure you guys subscribe to the channel and turn on post notifications as we make stock market content every single day. And if you guys want to be well-informed investors, you definitely want to join this community. And if you guys don't mind leaving that early like on the video, I will be very appreciative, as liking the video is the #1 thing you can do for a small creator like me on this platform. So without further ado, let's get right into the video. So I found this very interesting article on CNBC titled "Disinterest Driving the SPAC Slowdown is Misplaced," Money Manager says. And basically this article is talking about the recent meltdown in the SPAC market and what's been basically going on in April with SPACs, as there's been a lot less SPACs that have gone public in the last month opposed to the previous month. So we'll look at that. But it's very interesting to see what people's thoughts are on SPACs right now, because many of them are trading at $10 at their price floor. It's time to really break these companies down and see which ones are actually worth $10 a share, because there are plenty of deals sitting there that just don't have the attention that they deserve. So that is basically what this guy is trying to say, is that if you are a high growth company, the cheapest way to go public is through a SPAC merger. So there are plenty of good companies that are SPACs, which we just categorize as SPACs and pass that off. So we do have to look deeper into that. And like I said, I will be going over the SPACs that I still hold, and 2 of them are close to net asset value. One of them is a bit higher, but I did get in around net asset value. So going forward, let's get right into the article. Has the SPAC spigot run dry? New issuances via special purpose acquisition vehicles, blank check entities that raise capital to merge with private companies and take them public, dropped off in April, with only 10 new SPACs coming to market versus 109 in March, according to the SPAC research. So I want to take a look at this graph right here. So as you can see, this graph is pretty crazy. So it starts all the way over here in July of 2020. We had 8 SPAC IPOs in July, and then in August of 2020 we had 7, September we had 10, then it really picked up in October of 2020 where we had 33 new SPAC IPOs, then 20 in November, then 37 in December. Then it goes crazy in 2021 where there was 86 SPAC IPOs, 97 in February, then it peaked in March at 109, but then in April it comes back down to 10 new SPAC IPOs. So taking a look at the Defiance Next Generation SPAC derived ETF. Now, if you guys are curious, this ticker symbol is SPAK, and this is basically a ETF that holds a bunch of different special purpose acquisition companies. And with this chart, so it's very similar to the chart we see here. Around February, in March it was peaking. Around February we saw its peak at $34 a share, and ever since then it has really crashed down here, seeing a bottom of $24 a share. So that is a 33% loss in only around 2 months time. So that is something that is very interesting, and it shows what's going on with the SPAC market. Now if we take a look at QQQ, which is a NASDAQ 100 ETF, we can see basically they're trading at an all-time high still, and NASDAQ companies are also high multiple companies, so they have not been hit nearly as hard as some of these SPACs. So it really shows that this is the time to be greedy while others are fearful in the SPAC market, and really find the companies that are worth more more than $10 a share, but are trading at net asset value of $10 a share, because as you can see, we're down bad right now, and it's really time to be greedy, because in the future, if these SPACs do end up taking off again, I don't see why they won't, as the entire stock market is basically at an all-time high right now, and SPACs are at a low, and even cryptocurrencies are at an all-time high right now with Dogecoin popping off. So if the SPAC bubble is actually burst, there are plenty of other markets where there are bubbles right now, so I don't know if the SPAC sector deserves to be hit as hard as it was. Now, a big reason that there was so much worry here in the SPAC market, and we've seen a big fall off in the SPAC market, is because investors were particularly spooked by the new guidance from the Securities and Exchange Commission. So the SEC basically made it so SPAC warrants are now seen as liabilities on their balance sheet. So they will be classified as an expense now, which will basically hurt how their financial statements will look. That is definitely something to consider, because if financial statements look like they're running at a deficit because of these SPAC warrants, then the companies don't look as attractive, even though nothing has really changed about the company. And basically, whenever the SEC steps in and tries to halt something, then stocks do react poorly to those decisions by the SEC, and they fall because of it. So Morgan Creek Capital Management's Mark Musco told this to CNBC this week. So he said, "This is a long-term trend. The SPAC merger, we believe, will become the preferred method for high-growth, innovative companies, or what we call companies of the future, to go public." And like I said, when comparing the SPAC ETF to QQQ, the SPAC has been hurting while QQQ is sitting at an all-time high, and SPACs are also these high-growth technology companies for the most part. Obviously, they're not all technology companies, but most of them have a compound annual growth rate of above 20 to even like 35% in some cases. So these SPACs are also these high growth companies similar to technology companies. So it seems pretty insane to me that the SPAC ETF is sitting at such a low value compared to QQQ. Then he goes on to say that SPACs are the most streamlined way for retail investors to get access to newly public companies. And this is something I definitely agree with. The SPAC merger is so much easier to go public. If you are a private company and you want to get retail investment into your company, you would want to go public via a SPAC merger, just because it costs so much less and you can raise so much more capital for your company than doing a traditional IPO or direct listing. Now, that being said, yes, SPACs are a good way for retail investors to get into these high growth companies earlier in the company's life cycle. However, typically these deals have been done, especially in 2020, in the first 3 months of 2021, at very, very high valuations. And therefore, in the end, even if the retail investor does vote for this merger to go through, there is a very good chance that they end up paying a lot more for the company than it's worth at the time, just because of the SPAC bubble that we saw, in quotation marks bubble, because we're seeing all these other things go up still. So there's obviously two sides to the argument here. There's the one side of the argument that retail investors are paying a premium for these companies that go public via a SPAC merger, but then there's the other side of the argument that you're getting into these companies much earlier than they would have gone public in the first place. So it is a way for you to invest in an early stage high growth company without having to do the whole private equity model of investing. And with that, as you can see right here, he did say that you do need active management in the SPAC area. It is an area where average investors will probably not have the skills or capabilities to dive deep into what the team may be doing with their acquisitions. So you do need to have some active management in the SPAC space if you're going to be investing, and this is also a reason why retail investors may get burned going forward. Anyways, with that all being said, I wanted to show you guys my personal holdings in the SPAC space, just so you guys have an idea of what I'm personally invested in. I still have 3 SPACs. I did end up selling a few of them with the recent downturn, taking some profits before it was too late. And I still have a few left, so let's just talk about them right now. Alright, so the first one is Silver Spike Acquisition Corp. So guys, just a full disclaimer, I'm only going to be showing you guys companies that are still special purpose acquisition companies, not ones that have already gone through with their merger, so keep that in mind. So Silver Spike Acquisition Company, they are merging with Weed Maps, which is basically like Google Maps but for weed. So if you want to find weed, you use Weed Maps and it'll say like the different strains and all that stuff. So for me, this was a play on the weed industry, the legal cannabis industry. And I know plenty of people that have used Weed Maps before, so that's why I want to get into it. I want to get into it early. I like the company. Honestly, I only do have around 4 shares, which is only 0.27% of my portfolio because I did end up taking some profits on it. As you can see, it reached a peak of $28 a share, and it looks like it's bottomed out a bit, so I will have to consider buying some more. But when I did get in at around $13 a share originally, it's hard for me to go back and spend more money on the same company that I bought for so much less. I know it's like a mental thing, and this is a good price for the company at $17 a share. That's what it looks like. However, just that mental thing of paying more than you used to pay just will always get to you. But that being said, let's get into the next company. So the next company that I still hold is Pershing Square Tontine Holdings. So this is a special purpose acquisition company ran by the man Bill Ackman. So a lot of people like Bill Ackman. A lot of people don't like Bill Ackman because of what he's done over the past few years in investing. He profited a lot off of the whole COVID crash, and he did a lot of manipulation, and very controversial man. However, he does know how to make a few $1 billion out of a few $1 million. So a lot of people do like his special purpose acquisition company. This one is one of the only SPACs that you'll see that has a price floor of $22 a share opposed to $10 a share, because this SPAC is extra big. It's gonna have a unicorn company opposed to just any old growth company. So this one's pretty cool. And now there's not too much of a downside considering it's at $25 a share and can only really go down to $22 a share. So I like this one. I'm gonna keep adding to this one. And yeah, let's get into the next one. So the next SPAC that I have is Tortoise Acquisition Corp. So as you can see, the ticker is SNPR. I bought this one because the ticker symbol is sniper, and I just like to snipe those deals. No, I'm joking. I actually do like this company. They're an EV charging company that, unlike ChargePoint, they have a completely different business model of selling advertisements. So basically, their charging station is like a widescreen TV, and companies can pay to put ads on there, and then the customers get a charge for free because of the companies paying for advertisements on the charging space. So it is a really, really cool business model. And in my hometown, there is a Volta charging station. So they will be merging with Volta Charging. There is a Volta charging station in my hometown. So I had to go with this company just because I really like their product. I like their EV charger. I think it's better than ChargePoint in terms of the uniqueness of the business model, as well as the fact that it is free to use and companies pay for advertisements on it. I think it's very unique, and I think it could be very disruptive to ChargePoint, even though it's not the biggest one in the country. But that also shows if you pay $10 a share for this company, you are paying a much less premium than you would be for a company like ChargePoint or a company like Plug that has already gone up a lot. So I like this play, a legitimate company with a great business model, so that's why I'm in it. Alright, so that's all I got for you guys today. I really do think that SPACs are a great way to get into a company early on, and the fact that they're trading so much cheaper now is a great way to do what would normally be a private equity investment, which has now given these smaller companies the ability to go public through a special purpose acquisition company. So I think you can definitely find some great deals. I think that Volta Charging, or SNPR, is a great near net asset value company, just looking at what they've done and looking at their products, and I think all of that combined is very great. Obviously, we don't have the financial statements for this company yet because they have not yet merged. They aren't required to report in these financial statements, but I do know their product. I do see people using their products. So that all being said, I like the company. I'm willing to invest in a company I believe in, even though I have not seen the full picture by looking at their financial statements. Anyways, now with the SPAC market being at a very low price, it is definitely time to find these deals, because some of these companies can be 10x companies in the future, and they're just hiding right now as a special purpose acquisition company. So it is very important to do your research in times like these and be greedy while others are fearful, so you're able to come up with a great deal and find a great investment. Even though SPACs seem to be getting beaten up every day, if you're looking at this as an investment standpoint and you want to invest in a company for years and years and years on end, yes, getting into a SPAC around $10 a share could be a great way to do that. Anyways, that's all I got for you guys today. I hope you guys enjoyed the video. If you guys are still around, click that subscribe button, join the community. Around the time this video is going to be posted, I will put a poll up on my YouTube channel. Check out the community tab on my channel's homepage and you will see this poll. You can vote on how I'm going to be spending $100 on Monday. So every week we do a challenge where we make a YouTube portfolio. We invest $100 into Public, which is a stock brokerage that I really like. It's like Robinhood. Check out the description if you want to see more about Public, and you can sign up and get up to $50 in free stock. So it's a great deal. But anyways, I invest $100 a week and I let you guys vote on the companies I invest in. So definitely subscribe to the channel and check it out right now as you're watching this video. Anyways, that's going to be it for the video for you guys today. I hope you guys enjoyed. Peace.